China has reached an inflection point. The seemingly limitless wave of cheap labour that helped propel the extraordinary boom in its economy since the early 1980s is coming to an end. The movement of peasant farmers from the Chinese countryside to the cities over the past 30 years isn't just the biggest human exodus in history. It's the biggest migration of any type of mammal. This phenomenon has created 250 cities with more than 2 million people. That's equivalent to 88 Londons. But now the migrant miracle is ending, as the country hits what's known as the Lewis turning point. That's the moment when the flow of people to the cities dries up, and the demographic and productivity dividend slows and goes into reverse. The most obvious sign this is happening is the fact average wages for migrant workers have more than doubled over the past 7 years. This suggests a mismatch between supply and demand for low-skilled workers. And this contradiction is only going to get worse. China is aging rapidly, just as migrants are returning to their villages. This doesn't just mean the demise of the economic growth model that has served the country so well until now. It also has huge implications for a global economy that relies on China to manufacture its daily essentials. But this isn't just a macroeconomic story.
Okay, now, I mean, if we turn to an economy that's been hugely successful, I'm talking about China, I think it contributed to something like a third of global growth over the last 7 years, but it very much plays to those themes, doesn't it? It's an economy going through a transition. It does have an aging problem, but also it's trying to transit from being a manufacturer and an exporter to an economy much more based on consumer demand and services. And some people have talked about it getting into a middle-income trap. I mean, how do you think China can face those challenges best?
Well, first of all, I would observe that it is transitioning. And some 5-6 years ago, there was a concern as to whether or not it would shift from being purely export-driven to being more domestically driven, which is happening with a very heavy sort of pull from investment, probably excessively so, and a gradual shift, probably a bit too gradual, towards consumption. But it is moving from export to investment to consumption. And we very much support that evolution with the hope that the Chinese authorities will be able to grow their capital markets, make sure that enterprises of China will be able to respond to the needs of consumers and will be able to finance themselves. Together with that shift, you also observe a change in the governance, a change in the economic structure of China, with hopefully a reform of the state-owned enterprises and more reliance on market.
The world's second largest economy faltering. China wants to give its economy a boost. That is why they did the devaluation. There are numerous consequences, though, intended and unintended.
To help us break this down all further, Rick Liu, President and CEO of Star Strategic Partners. Good to see you.
Same here.
So we just got a lesson in foreign currency and how it all works. I hope our folks wrote down all the details. But ultimately, let's start with the timing of this, because a lot of people are making a lot of noise about the timing. Why do you think it was done right now?
Well, before we talk about timing, why surprise? What's the world when China actually increased the value of this currency by 8 to 10% in the last 12 months? During the same time period, the euro and the yen actually both declined against US dollar by about 10%. So there's a lot of reason why China is doing this.
In terms of the timing, the critics would argue that it's going to give Chinese exporters an advantage. I mean, you've heard all the arguments.
Right.
Do you think that's fair, what the critics are saying?
Well, GDP needs to get to 7% for China for a very simple reason. It's a country with almost 1.4 billion people. Every year, in order for them to generate about 30 million jobs to maintain social stability, you have to get to 7%. And export is a very major reason how they get to 7%. When you have a month of July where export actually slumped by over 8%, that's pretty major. So in order for you to hit the annual target, you have to do something about it.
And China's surprise currency devaluation is affecting Asian economies, and Korea is absolutely no exception. In fact, Korea is the second hardest hit nation, with its default risk reaching its highest level in 6 months. Han Da-an has the details.
Korea's credit default risk hit a 6-month high as China lowered its currency for 3 consecutive days in an effort to bolster its slowing economy. The market research firm Markit says the CDS premium for Korea's 5-year foreign exchange stabilization bonds reached 63.1 basis points on Thursday, the highest since February. That's a 20% jump from last month. A CDS is a financial agreement that helps lower the risk of loss for bondholders. A CDS premium is often used to measure the creditworthiness of a company or country. Market watchers say the sudden rise in the risk premium points to increasing concerns over China's sluggish economy and whether the government's stimulus measures will be enough to shore up growth. There are also concerns about the possible impact on Korea, a country that's highly dependent on the Chinese economy. The risk premium has also risen in other Asian countries as well over the last 3 days since China announced its currency devaluation, but only Thailand showed a higher increase rate than Korea on Thursday. Malaysia trailed Korea with a 13% jump, followed by Indonesia, Kazakhstan, and the Philippines. The CDS premium increase rate was relatively low for other developed nations, including the U.S. at 3.9%, the U.K. at 2.8%, and Japan with one of the lowest figures at 0.6%. Han Da-an, Arirang News.
Currencies are like scales. When one goes up, another must fall because they're measured against each other. A weaker currency helps a country in 2 ways. It makes its exports cheaper to other nations, and it helps domestic business by making imports more expensive. China's actions this week were driven by an urge to help a seriously ailing economy. Growth is now at a 25-year low. They're doing publicly what other countries may do covertly. The danger is that their trading partners will respond to the currency devaluation by devaluing their own currency, and the war is on, which in the end reduces global trade with devastating consequences. This currency war is different from previous ones, largely because one big player, the United States, can't really take part. Global investors seeking safety want to put their money into the greenback, and that makes it hard for the U.S. to weaken its currency. That's something that could put the world's biggest and most important economy at a disadvantage. And as Canadians know, something that hurts the U.S. economy has consequences for us all. Amanda Lang, CBC News, Toronto.
Until today, China's currency was tightly monitored and was only allowed to fluctuate within a narrow, predetermined range set by the central bank. But this morning, that all changed. In a shock move, the People's Bank of China announced it was letting market forces play a bigger role in valuing the yuan. Instead of the PBOC setting the midpoint of a 2% window in which the yuan could move, now that midpoint is based on the previous day's closing price. The policy change meant a one-time yuan devaluation of 1.9%, according to the bank, because the key midpoint value had been divergent from the market rate for some time.
The market has been calling for some reform to the fixing mechanism for some time, and actually we ourselves has been calling for such reform to happen within this year. So there was always, I think, an expectation that the PBOC will eventually do something to make the fix more market-driven and more transparent.
Now, some will claim China is weakening its currency intentionally just days after poor export data signaled another headache for its slowing economy. And the United States has long accused China of keeping its currency artificially low to help its exporters. But China's central bank says this move is part of reforms designed to have market forces have more influence over the yuan. That could boost China's campaign to have the yuan included in the elite grouping of currencies used by the International Monetary Fund. To be included alongside the dollar, euro, British pound, and Japanese yen would lend major prestige to the yuan, a currency already being used more and more in global transactions. Stephen Zhang, CNN, Beijing.
China has a hot new export market turmoil. The eyes of the world are on the Shanghai Composite and on the daily fixing of the renminbi. Sometimes that doesn't make for pretty reading. Martin Wolf is here to tell me his take on it. One possible solution that got put forward in Davos, Martin, was that tighter capital controls. This was the idea from Bank of Japan Governor Haruhiko Kuroda. Will this work? Is this a plan that can, or is this desperate measures?
I suspect a bit of both. I mean, China still has exchange controls. It's not a fully liberalized system. It's moving glacially, I think appropriately, to becoming a fully liberalized system. They could tighten the controls. And at the moment, or at least indeed now for quite some months, they've been losing foreign currency reserves at an enormous rate. They've lost almost $700 billion in the last year and a half. And even for China, which has $4 trillion of reserves, or had at the beginning, this is an enormous amount. So they can't really continue to do so. They're obviously doing it to try and stop the exchange rate from collapsing. We all want it not to collapse because it would create a big deflationary shock for the world. We really don't need that right now. But on the other hand, they really don't want to continue like this. So what are the alternatives? Well, basically, in the short run, the simplest thing is to stop the buying by Chinese people of dollars. And controls would do it. Obviously, we then have to get into the question of why are they buying dollars? Part of it is straight capital flight, I think. People are frightened about the anti-corruption campaign. Part of it is a lack of good investment opportunities as the economy slows and they've been investing far too much. And part of it is Chinese corporates trying to redeem debt which they contracted in dollars, and they now realize the dollar's rising, the renminbi is falling, it's getting more expensive all the time. And so this is what's going on, and some of that the People's Bank could stop if they really wanted to.